Viewers, welcome to my channel, Sensor 360 Investor. Today, we're going to focus in on the markets segment of our 360-degree framework of trading and investing. And we're going to focus in on a few topics, quite a few more than this actually, but we're going to look at bottoms. Are the markets bottomed, or are they bottoming? We'll discuss kind of a rolling recession, since there's a lot of talk in the media about that. And let's try and decipher which way we are heading and try and put some timelines on that. And then there's also some additional topics in there as well. Okay, so before I begin, a quick word about the disclaimer. This channel is not providing financial advice. Please pause, read through this, and then continue. Okay, thank you. So without much further ado, let's begin this show. All right, so I'm going to use this as an orientation. I introduced this in the last video that we had on the markets. It's a fairly popular chart. It's been around for a while, and you can get it at wallstreetcheat.com. So we want to use this as a map, and also let's try and validate to see how this plays out, or how much accuracy there is. And we'll look at past super bear markets to help us to do that. But I'll be coming back to this chart frequently. All right, so before we get there, let's just have a quick look at some of the US markets. And this is a 1-year time frame. And so we can see that the NASDAQ has picked up in terms of strength since its lows that placed last year. The S&P 500 itself has been kind of hit a low point and now been moving up since then. And then, but however, on the inverse side, the small caps are still near their lows, and they're kind of retesting close to some prior support zones. So the small caps are not participating. So what this gives us is a mixed picture. So we can't tell from this alone. So let's move on forward. If we look at the US sectors, the first thing that strikes us that and this again is over year. So in terms of strength over year, the staples are outperforming the sectors, closely followed by the tech stocks. And obviously the tech stocks have quite the bounce this year, so they've come into play. Only these two sectors are ahead of the index itself, the benchmark. And just behind that is healthcare, utilities, both defensive. So this picture kind of still gives us a heavy defensive tilt. And then you also have real estate. And then way down here, you've got a couple of growth sectors. And then you have some of the more cyclical sectors. Financials are not participating, and energy has started to roll over a little bit relative to the others. But that's obviously coming off a super year last year. And so this gives us a bit more evidence, but again, not really heavily leaning one side or the other. So let's have a look at the mega caps. And here we see that both Microsoft and Apple have basically driven a large part of the move, but in supporting it, and Walmart's done well. Meta's had a big bounce of this year. Nvidia had a tremendous bounce with all the AI hype that's going on. Visa's strong. That's kind of telling us, okay, if Visa is still strong, then there's not a lot of defaults and defaults going on with credit cards. Google is not participating, so this is kind of sitting this one out at this stage. Johnson & Johnson's had their share of bad news recently. And then we have healthcare. Tesla has come off the wheels a little bit, so Google and Tesla are not participating. But energy obviously had a big run last year. And we see ExxonMobil pulling back a little bit, but still over a 1-year time frame showing some strength. So this is where a lot of the heavy lifting in the indexes are coming from. And if we look at the volatility, we can see that where we are, the volatility index is well below 20. And it's at an area where we can expect support and an upward bias into the markets. And if we look at the markets themselves, here we see it. So here's the upward bias that we currently are experiencing. And we can see that from this year's position at the opening of the year, we're pretty much in an uptrend pattern. But if we go slightly to a bigger frame, then we're still kind of in this larger trading box. But no, it's clear, there's an upward bias here. All right, so let's move on and take a look at the market dashboard, and we are still building evidence as to which way this market is or may be going. So we know that the Fed is active and the Fed is in a hiking phase. So the Fed is red. The market is actually, since it's in an uptrend and it's above its key moving averages, is green. And so we have the classic, don't fight the Fed, don't fight the tape. These two are at loggerheads. And despite what the Fed is doing, the market seems to be oblivious or complacent. And then if we look at the economic indicators, all the leading indicators are showing that the economy is in trouble. We're heading to a recession. But if we look at the economy itself, the economy is actually doing very well, thank you. Employment is good and people are out there buying. Here is a picture of the Fed hiking since it began. So these are all the rate hikes, so just for FYI. And we can see pretty much we went from 0 up to 5%. So that's quite the hike in 1 year. In terms of economic activity upcoming, obviously everyone's going to be looking at the inflation numbers. So we have CPI and PPI being printed next week in terms of reports. Okay, so now let's go back to the cycle and and take a look at this. And we're going to look at past bear markets, and then we'll look at where we are currently. So I want to focus in on this area initially. So we had the bull market, had the first thrust down, drop from the peak, and then we have this counter bear market rally, which according to the cycle is called complacency. So let's look for evidence. So here's the 73 market, and as we come down, we can see, okay, so here's a bear market rally. So that seems to rhyme, and then we got the later drops. And in future videos, as the market trends, if it does move this way, so I'll keep this front and center and we'll track this. But as of now, we can say, okay, potentially that seems to rhyme there. And then if we look at the tech super bear, again, here's our initial thrust down, and then there's that bear market rally thrust up, the complacency stage. So that seems to be rhyming. That thrust down, complacency stage. And then if we look at the financial bust, so not as pronounced, but you do have the tech, you do have your down move, initial down move, and here you can see like the undercut, and then we get our bear market rally, and then we fall away. And here we see first move down, undercut into the rally. So definitely on those three super bears, it's rhyming so far. And then here's the current market. So here's our first thrust down. We can see that. And then here's our undercut of this low here. And then we're moving up in this current phase. So that seems to, and here's the current market right here. So we can see how that seems to be rhyming as well. So there is definitely a strong argument to be made that we are following the roadmap, and if this pans out as per the roadmap, we should expect to fail soon and start the next leg down. If that doesn't occur and we get above these levels here, then obviously we're clearly putting a bull market. But we'll take a look at some additional support there. So far there is reason to believe that we are following the roadmap. However, we need additional data to continue to buy into that argument. So definitely looks like we do fail, and then we have these future stages of anxiety, denial, panic, and none of these moods or animal behaviors are evident in the markets yet. Okay, so again, let's take a look at small caps. Small caps, without small caps, you can't really have a roaring bull market, because this is the engine to a large extent that's going to push the market up. So small caps are not participating. So this is suggesting that we do have divergences in the market. If we look at financials, so there's another area we want to look at to see how the financials helping us out. With the massive rate hiking that went on, obviously we now have some distress in the financial markets with the regionals, and so at this stage, the financials are not participating. um, Semiconductors is another area to keep an eye on. So this one is participating. So in line with the market lows, it is got on a strong upward bias and it's moved off. But this is also reflective of what's happening in the tech industry. So tech, semis are both showing the same pattern, and the index is reflecting what's happening with tech and semis. So again, mixed bag. And then if we look at sentiment, so two things to note here. One, we've had an uptick in bearishness. So bullishness has stayed the same, but people have come off the fence in terms of the neutrality and moved from neutral to bearish. And then our gauge over here is also tilted into the kind of the greed. So we're getting a little moving towards the frothiness, which means the market might be getting ready for a little pullback or sell-off. So definitely the key takeaway here is that more people in the past week have come off neutral over to the bear camp, and interesting, those that are bought into the bullish argument, that's stayed the same. So they haven't adjusted their views yet. Okay, so let's take a look at business cycle. It's not again, this ties back to the stock market cycle graph that we're looking at. But so the key thing around the business cycle is to always look at the risk and look at the data, etc. So the risk in the business cycle is that where we are, we have the lag effect. So with the hiking that's gone on, we haven't seen the pain in the economy yet. And so economists call that the lag effect. So they're saying that from the time that the rates go in, there's usually a 6 to 9 month lag that takes place before we see the impacts of that occurring in the economy. So we're seeing the first impact, which is with the regionals, and we haven't yet seen an impact on employment and other aspects of the economy. And if we take a look at market breadth on the benchmark is up 7.73% as of this weekend. And the stocks beating the benchmark. So these are the ones that are outperforming 7.7. There's 31% of the stocks are beating. Stocks that are below the benchmark is 68. So here, key takeaway is that you can almost 2/3 of the stocks are underperforming the benchmark. Stocks that are below the benchmark but still in positive territory is about 1/5, and stocks below that are negative is almost half. So that's telling us that the upthrust or the participation in the market isn't as broad as it looks. Then we take a breadth indicator, stocks above the 200-day. So less than half of the stocks are above their 200-day, but it's getting there. So these numbers would need to be improved a little bit more for us to begin to believe that, okay, so the worst of it may be over, and we are now truly in a bull market uptrend. So we need to see more improvement here, but they're not that far away from where we are at the moment. Okay, so that wraps it up. So what we have a mixed picture. So we have evidence to show that the bulls definitely have a strong argument to say, what we've done, and it's time to move up, and we are heading in that direction. The bears have an equally strong argument with the weight of evidence, and all of the factors are in play, and the late cycle that we're in, to say that the pain is not yet over, and we have not experienced that yet. So over the coming weeks, we obviously will continue to track this and to see which way this market is really going to move. But as it stands, it's kind of in pause mode almost, right? Hasn't quite made its mind up as to where it's headed. So we have to watch diligently, and then as the evidence presents itself, it'll give us a better clue as to which way this market's going to lean. So if you are a subscriber, thanks for subscribing. If you haven't, so please do subscribe, give it a thumbs up and share with family friends. That wraps it up for this video, and I will see you on the next video. Thank you and goodbye.